We'll get started. All right, welcome, ladies and gentlemen. My name is Fausto Pugliese, president and founder of Cybertrain University. Welcome to Thursday. Hopefully everyone had a wonderful Thursday day in the market. Looks like we broke another all-time high. For 1 point, we just break it, and looks like oil's taking a big hit, which I think is also going to make everyone very happy. But where there's catastrophes, there are opportunities, and there's no better opportunity than to have my next guest that I have here, one of our very well loyal channel partners that we've been doing business for a lot of time. We did a lot of events with David Anton from Value Charts, and he's basically going to be covering the 11th hour of option spread strategy. Now, I tell everybody this: I'm not a big fan of swing trading, because why go buy when you could lease? And that's why I always look at options. And you know, I trade options a lot. We have an options course here. We bring option speakers in all the time. And the thing is this: you could always learn something new on the ideas of how to trade when it comes to understanding option spread strategies. So you got a great event, and one thing I admire about David by being here, he's also been a very, very great contributor towards the education community when it comes to trading, a loyal asset, I would say, when it comes to educating the world of trading in the markets. And that's why we have him here today at cybertrainuniversity.com. So without further ado, ladies and gentlemen, don't want to take too much time. He's going to go probably about an hour, and he's going to teach you all the great values of, you know, trading and how to use technical analysis, also option spread strategy. So without further ado, guys, here's the stage. David, the stage is all yours. Enjoy.
Thank you very much, Fausto, for that great introduction. Guys, I've been watching Fausto trade for a number of years. Been very involved with him over the past year as a partner, and the education you guys get is wonderful through Cyber Trading University. I'm very happy to be able to meet you today. I am actually the stocks and options live analyst for Value Charts. I run an option and stock live trading room every single day that the market is open, and I'm very happy to be with you this afternoon. I am going to bring you what I call my 11-hour option spread strategy. It's something that we do in our trading room, something that I've taught in the past, and we found a lot of success. And with this specific strategy, a lot of our traders tune in every week just for this strategy, just seeing what we're thinking. And as I'll show you, it's a very consistent way to bring additional funds into your accounts as you're trading on a weekly calendar. So let me make sure my screen is updating. Okay, those of you that are not familiar with the GoToWebinar system, feel free to go ahead and submit your questions via the GoToWebinar side menu. Now, I'm going to try to answer questions as we go, but I won't let it interrupt with the flow of information. If I don't answer your question immediately, it's because I'll probably answer it later on. And if for some reason I don't catch it, feel free to submit it at the end of the webinar also. Yes, this webinar is being recorded. Thank you. All right, really quick risk disclaimer. We just want you to know that I'm not going to read it verbatim, but you know, trading or investing carries a high level of risk. You should invest or trade depending on your investment objectives, your ability to tolerate risk, level of experience, and you know, the education that you've received in trading and investing. Now, we've taken every precaution to make sure all this information is accurate, but we want you to know that any past performance of any results, we've done our best to represent it exactly as we're showing you, but we also want you to know that past performance of any trading system is not necessarily indicative of future results. Last is the CFTC Rule 4.41. Very similar thing, information the U.S. government requires us to show this to you. Again, we're not soliciting you to buy, sell future stocks or options, but we want you to know that investing carries both rewards and risks. Again, past performance of any results or trading system is not necessarily indicative of future results. Okay? All right. A little bit of information about me. Again, I'm the stocks and options live trading room specialist. I've been doing it for over 21 months in live every single trading day. Have a ton of fun in that room. Make consistent money. We make friends, and we watch the markets and we trade. So it's a tremendous amount of fun. I graduated from Vanderbilt University in 1995. I became a full Series 7 broker at age 23 with Merrill Lynch, and I was there for 4 years. And after that, I transitioned over to the Vanguard Group. I worked over 12 years as a senior advisor in their asset management services ultra division, and I was responsible for high net worth portfolios and utilizing option strategies on highly appreciated stocks, so we could both manage cash flow as well as take tax loss harvesting in a very creative, structured sort of way. So I've been dealing with stocks and options for a number of years. Okay, so enough of that. Just going to show you the overview for our webinar this afternoon. The 11-hour option spread strategy is going to be broken into 3 different sections. The essential Greek of time. Those of you know that know options know that there are things we call the option Greeks. I'm going to talk about the specific one that we're most interested in as it pertains to this strategy. Then I'm going to talk specifically about time decay and how the time decay of options can be charted out on a weekly calendar. And then I'll jump right into what you guys are most interested in, the actual 11-hour option spread strategy itself. Okay? All right, excellent. Thank you. All right, so next is the essential Greek of time. Now, what do we mean by that? If you understand what an option is, it's a derivative. It derives its value specifically from aspects of an underlying thing, whether it be a stock or a future or some sort of vehicle in which we can apply specific parameters. One could be price, one could be time until expiration. You can also talk about the risk-free rate of return. Those different factors, volatility, all those things come into play when we're trying to figure out what is the value of this option. Now, again, the one that we are most interested in is what we call theta. Oops, excuse me. Theta is the Greek that we're most interested in because it describes the option sensitivity to time decay. Okay, and if you're very familiar with theta, you can understand that it's a geometrically accelerating decline. Like, what is Dave talking about? Is just like when you purchase a new car and you drive it off the lot, the value of that car actually drops the moment you take it for a ride after you sign on the dotted line. It is a depreciating asset. Options are exactly the same. It is a depreciating asset because it actually has a limited time span. So when options decay, they basically start on a gradual level and they accelerate till that the rate of decline increases exponentially until we get to 0. All right, again, just by definition, theta is the option sensitivity to time. It is a direct measure of time decay. This amount increases rapidly as the option approaches expiration. Basically what I mean, the effect of theta increases rapidly as the option approaches expiration. Now, when we're talking about monthly options, which are 90 days out, 60 days out, even 30 days out, the greatest rate of loss of the value of these options is in the last month. Now, for weekly options, those are options that have a lifespan of anywhere from 7 to 10 days, the greatest rate of loss of value to time decay is in the last 1 to 2 days. Now, Most of you are probably familiar with buying puts or buying calls, depending on which way you think that the market, the underlying stock is going to move. Well, you ever think about the people on the opposite side? Those are the option sellers. What they do is they use theta to their advantage. If I sell you a depreciating asset, as time passes, the value of the asset I just sold you is actually less. So I always have the opportunity to buy it back and basically cancel out my responsibility in the transaction, my risk. So that option sellers use this theta to their advantage. And what we're going to do is talk about selling credit spreads, which is basically the same thing. We are collecting money due to time decay. It's almost like you're making money as your car is depreciating. It's a very interesting concept, isn't it? All right, so again, this is what I mean by geometrically accelerating decline. This is the value at 90 days, and that looks like it's about 5. Okay? Here, 60 days out. That looks like it's about 4. 30 days out, looks like it's worth about 3. 15 days out, looks like it's about 2.1. And then 5 days out, it looks like it's worth about 1.0. And then in the last 5 days, the steepest slope is right here, and it pertains right to the last couple of days. So that's what I'm saying. So 90 days out, it only for between 90 and 60 days, it loses about 20% of its value. Between 60 and 30, it loses roughly 25% of its value. Between 30 and 15, it loses roughly 33% of its value. In the last week, I had to double check that. Last week, it loses 50% of its remaining value. And if it's out of the money at expiration in the last 5 days, it will lose 100% of its last remaining portion of value. So that's what I mean by accelerating, and you can see it becomes more and more pronounced, the rate of decay. So if you are an option buyer or seller, which side of the fence do you want to be on? I want to be the person that's benefiting from time decay. As time passes, I make money. That's the essence of the effect theta has on options. All right. Any questions on theta? Hey, John, ask me about ask that question again later on at the end. I'll give you my response. R. Rawson, I'm going to answer that a little bit later too. All right. Well, thank you. Let's go ahead and keep moving here. All right. So I've shown you the theoretical. I've shown you the academic side of what is theta. Right? Let's look at it from a practical, I'm a stock trader, I'm an options trader point of view. What does time decay mean to you as a trader? How does that apply to us on a weekly calendar? Because as you can kind of guess, we're already talking about where is that theta, where does it have the strongest effect? Well, it's in the last 1 to 2 days. So really we're dealing with weekly options on a weekly calendar. Okay? All right, so again, I'm not going to reread this, but I want you to understand, again, for weekly options, which are the ones we are dealing with, the greatest rate of loss of time decay is in the last 1 to 2 days. Okay, last 1 to 2 days. Again, the side of the fence that we want to be on is the person collecting money due to time decay. Okay, so we are selling credit spreads. All right, so here is the weekly calendar. Now, note which day of the week are we in right now? Thursday. All right, so again, Monday, Tuesday, Wednesday, in my trading room, we're doing a lot of directional trades, some swing trades over a couple of days, and then Tuesday going into Wednesday, we're looking at credit spreads. Now, we do different kinds of credit spreads in my room based on different time frames, but the one that you want to know about today is the one we did today on Thursday. This is what I call my 11-hour credit spread strategy. And you're like, that's a really weird name. Why 11 hours? Because we actually institute our trades roughly 12 noon on Thursday. That is roughly 11 hours. It's about 10.5 hours until the markets close on Friday at 4. So with that knowledge, we're only in the markets for a total of roughly 11 hours. Okay? And then Friday, that is the last day you can trade these options before they actually expire. Okay? So we're just managing our positions and you know, watching our profits roll in. All right, so again, this is on a graphic. This is the time frame we're looking at. Thursday going into Friday is our 11-hour credit spread strategy. Roughly 11 hours, which is 12 p.m. Eastern. Okay? All right, so hopefully that makes some sense. Yes, John, definitely. All right. All right, so that's pretty straightforward. The days that we'll be focusing on primarily are Thursday and Friday of every week. So let's go ahead and jump right into the strategy now. This is what you're looking for. The 11-hour option spread strategy is, and this is just a brief overview, is a very high probability trade. Okay? Now, initially when I did this first webinar, I said it's 80% successful. 80% successful as applied according to the strategy. Now, I will actually show you a little bit later that my success rate is very close to 94%. But that's generally as it's structured, but the way we apply it and the way we're we're a little bit conservative, we tend to be correct roughly 94% of the time. Now this particular strategy, what we are doing, it has actually an overnight trading focus. We are looking at the noon and afternoon time period on Thursday, and we want to see the positions go into 4 p.m. close on Friday. Okay, the most important aspect of this and time decay, okay, is theta in the overnight transition from Thursday into Friday. That overnight time decay has a really strong effect in the profitability of these trades. Now, when we put the trades on, we are talking about trading based on a daily and 60-minute chart. Now, as we evaluate the positions and the candidates for their suitability on this trade, we are looking at aspects of momentum, how strong it is moving, and in what direction is it moving. We're well aware of previous price action that creates support and resistance levels on both daily and 60-minute charts. And then based on the price action also, we are also looking at Fibonacci retracement and extension levels. Again, the trading goal here is for overnight time decay to create an overnight income. Okay? Now, price action and the way the price of the underlying moves is also an effect, but really we're looking for that big move or big drop in the value of the options that we sold overnight. Again, Thursday going into Friday. Okay. All right. So again, probably if you're in here and you have an interest in options, you're very good at buying puts and buying calls. So you've seen that type of trading before. Now, when we are selling credit spreads, it really makes us pause and look at the trade from a different point of view. We want to focus on selling short strikes. Remember, it's a credit spread, and we want to do that, and this is key, away from the projected price direction. We want to know where prices will most likely not be at expiration in the next 11 hours. We want to know where will prices most likely not be. Okay? And again, just to reiterate one more time, Profits come from theta decay. And theta decay is theta decay of the spread, which are out of the money options. And we're going from Thursday into Friday. Generally, when we do this strategy, we're looking to generate anywhere from 4 to 8% per week. Okay? I'll tell you, it's actually a little bit closer to 4, 4.5, 5. Okay? Sometimes we get this 8. The setup has to be really good. But 4 to 8%, basically you're making $40 to $80 per $1,000 per week. Now we do have really good risk control parameters, and we're risking potential loss of 2 times the credit amount. So if we're looking to earn $40, the most we're willing to lose here is 80. Okay? If we're trying to make $80, the most we're willing to risk and take a loss on is 160. Those of you that have traded credit spreads know that generally there is a large potential risk, but this is where we place our stops, based on 2 times the credit that we are expecting to receive at expiration. Okay? Don't worry, I'll explain more a little bit later. All right, so let's talk more about this idea of where are we going to sell the credit spreads. Well, this is how I see the stock chart, and this is how I normally evaluate it. So the price is coming down, and we come down into this level right here. You find some support at 856.5. We bounce up in Google, make this nice intermediate high. We come down, we make a series of 4 lows right around 845. This 845 is followed by a nice bounce in Google. Now what you know, if you traded divergences, this first low corresponds to this histogram profile. Now the second lower low corresponds to a weaker bearish profile. The first move is relatively strong. The second move lower is much weaker. So what happens? Momentum shifts and it carries this up. Now, the purpose of this example is not to demonstrate a bullish divergence, but it's the fact that now we are moving up. Okay, we have higher highs, higher lows, momentum is moving up. The question is, if everything's moving in this direction, where will prices most likely not be in the next 11 hours? Probably right down here. Okay, it is not only away based on momentum, it's hopping because you actually have to turn around, do nearly a 180-degree move and come back down. Okay, but also you have a support level here based on that swing low, support level here at 845 based on that swing low, and if these prices are going to come down and break the 840 short strike level, then it has to not only turn around in its momentum, but break below these support levels at 856 and 845. So that is where you would generally write this credit spread. TJ, yes, yes. You would input those at implementation. So right here, similar situation. This is CMG. Looking at the daily chart, you see CMG for a number of bars has been in this sideways price action, this channel. What happens? Momentum breaks to the downside. Prices fall below the bottom channel. Momentum is accelerating lower. The question is, if this is the trade right here, where will prices most likely not be? Back up here towards $550. Okay, so you would sell your short strike 550 by 555 right here, because not only does price have to turn around, but it has to get through this previous support level, which is now resistance, and then it has to break through this support level, this resistance level, where it couldn't do it the last time. So there's a lot of protection on this particular trade also from going back and not attempting to challenge the 550 level. And it has to do it within 11 bars. Yeah, don't worry. This is a daily. Just assume it's 1 hour. All right, 60-minute bars. It doesn't matter. All charts are fractal. Okay. All right. Next, this is Tesla. Again, ignore this. It might be a 60-minute bar. Here's the first high. Here's how strong we are. Here's a nice higher high. See how we're barely green. So what happens is price starts to fall. Momentum is rolling over. Where will we sell our short strike? Well, we have a high here. That's a resistance. That's a resistance level. The high here. That's a resistance level. Guess what? 190 is good. Okay, 190 by 200, something like that. All right. You'd have to turn all the way around, get through this resistance, and then go through the 190 level, all within 11 bars. That's why credit spreads are high probability type trades. Okay, I'm not going to do the same thing, but again, this is a double top. Momentum is starting to roll over. Okay. Does ATR have any value in determining the breadth of the daily move? Yes, John, sometimes. But I try to pay closer attention to the price action, the momentum, and the support and resistance levels, because ATR tells us what we may do based on historical highs and lows and the distance the stock moves within the day. But the price action within just within the past 20 or 30 bars is going to tell us where it most likely will go. Okay, we do a lot of this directionally. Okay, now here's the summary of the 11-hour option strategy. What are our goals in this trade? First of all, we want consistent winners, we want consistent percentage gains, and we want to control our losses. Right now, I'm not going to digress too far, but this is a chart I like to show. Because remember, I had said this strategy, we're trying to earn anywhere from 4% to 8% every week. Well, let's just start something that is a little bit more conservative. Let's start with this number, 3%. If you can implement this strategy and try to make 3% every week, and you start out with $10,000, if we just run it through a mathematical process, 3% per week is equivalent to a little bit more than 12.5% per month. All right? So what happens if we keep doing this strategy week in, week out through the course of 1 year? Well, your $10,000 will quickly grow to something more than that. I have that mathematically as $46,000, and yes, it does roll itself over. We do reinvest it. Okay? So again, 46,000, and then you can extrapolate it going forward. I'm not going to do that. I'm not going to sensationalize it, but I just want to show you what this looks like with just 3% per week. You want to look at 5? Go right ahead. Okay? But just that's what it looks like. And you're like, okay, Dave, that's fine, but show me what you've done in the past. Okay? Here is a good example of how we set up our credit spreads every week. Okay, so here is Tesla. Tesla is a bearish call credit spread. We did this on 7/18. This was at roughly 12 noon on Thursday. Oh, I'm sorry, 7/18 is when it expires, so we did it on 7/17. You see it's a $5 wide spread. So and then this is 10 calls. Usually each call requires $500 of buying power, and we're getting roughly $44 because you have to multiply this times 100. I did 10 of them, so we're looking at 440. Okay. Guys, I see your questions are coming in, so thank you for that. I'll try to address it. I just don't want to interrupt the understanding here. Okay. The next is CMG. Again, this is also a $5 wide spread. It's something that I normally try to standardize. Most of my credit spreads are $5 wide, so they're easy to understand. Okay, I did 10 of them, and the credit I received was 30 cents. That brought in $300. Price line, other bearish call credit spread, and that brought in $250. Now, the requirement to do these 10 contracts was $15,000 for 10 here, 10 here, 10 here, right? If you don't have those funds, you could do 2, 2, 2. That would be a total outlay of $3,000, okay? But basically what we earned here was $990 over 15K, and that is 6.6%. Okay, not bad, 6.6% that week. All right, again, everything in green is what I'm looking at, because the ones in white, that's a part of a different strategy that we're doing. But those green ones, the 11-hour trades, brought in $670. Okay, that's 4.5%. Okay, now I can do this for each one. Here we just had 2 this week, here and here. We brought in 1,030, and this was 6.9%. Okay, 430 here, 600 here. Okay, 6.9%. Now this week we actually went crazy with 11-hour trades. There actually were this many great opportunities to do this particular trade. This was a 8-7 and it expired 8-8, and you can see we made 300, 200, 400, 320, 300, 160. That was a 1680 we made on $29,000 outlay. So this is 5.8%. Now someone's asking me, you know, what about based on 10,000? Guys, you're just going to have to extrapolate that. Based on how many contracts you do, how much capital you have. Basically, you go, you're looking, if you have a $10,000 account, this will bring in $580. Okay? I traded this with 3 times the size. That's why I made $1680. Just divide it by 3. Right? 580 this week. This one, excellent, same thing. Now, I had trouble with my weekly ones, and I took some losses, but were the ones in green, I'm just going to circle some of them, 200, 130, 220, 300. This was about 4.3%. Not as good as the previous week. Okay. Now we can keep going. This was 5.3%. You can see there's a general trend, 5.3. This is 5.1. A couple of my weekly ones got stopped out. You can understand this is a more volatile situation. Another thing too, sometimes when we have ones like this in my trading room, I have ones from like Tuesday and Wednesday, and then I tack on an 11-hour trade. This is basically an iron condor, but they're legged in, so you don't have to outlay anymore, and we can increase the return. So that's 5.1% that week. The stocks that I pick are, if you can see the ones that I'm using, in my room I consistently monitor and manage probably 12 of the largest stocks with the highest option volume and the largest price. I like these high price stocks because they provide a lot of fine detail as to where I can put my short strike and do my spread, plus the volume is there, plus the bid-ask spread are relatively, they're narrow compared to other stocks, and most importantly, I can fine-tune where I sell the short strike. Here, sell 450, sell 665, sell 585. Again, it goes back to the idea of where my support and resistances are, how far away can I move my strike, etc., so that I could get a decent credit. Yep, and they also tend to have really good high implied volatility also. Okay, plus the fact we look at them every single day, so we're trading them both intraday in the room, and then we also do a credit spread on it. So we already understand the nature of that stock. We also understand its recent history as to how it's moving. that helps us do these credit spread trades right away. Okay, now this one this week was 4%. Okay, 4%. This was a way out of sorts kind of crazy, took some risk kind of week. 8.5% return. And you can see in Baidu and GMCR we're a little aggressive. So overweighted those positions, and we really did well that week. Now I'm going to skip forward. Oh, this is the one I wanted to show you. Oh no, that is the one. All right, this is the one from last week. Amazon, Tesla, and pricing. The week before this, we actually got stopped out of 2 of our positions. When we had, over the past month, we've had 3 positions that got stopped out. And again, we control our risk according to that parameter of 2 times max gain. And we got stopped out. And that's just part of it. But you were having days that we were moving plus or minus 1%, 1.5% every single day. So by nature, we would tend to have trouble on those days. But things are kind of back to normal. Here's Amazon. We made 10 contracts, we made 290. Here, Tesla, we were aggressive on. The setup was really good. 600 there, 250 here. So on an outlay of about $20,000, looks like we made probably 1,100. So that's about 5.5%. Okay? I mean, it's very nice to get very nice returns, but the reason for our consistency in these trades is the way we set them up. How do we pick our strikes? What time frame do we use? And all those sorts of things. And that's definitely something I share. All right, so let's look at these goals just again and how we outlaid them earlier. Again, our goals are consistent winners, consistent percentage gains, and we want to control our losses. All right, so over the past 5.5 months, no, that's not. I'm just trying to go back and see how many trades, roughly 13 weeks we've been doing these trades. We took roughly 53 trades, and out of those 53 we had 50 winners. Again, that's 94%. Okay, and when I say winners is that they expired at maximum profit. Okay, now we want consistent percentage gains. What is the average weekly percentage gains in this strategy? Roughly 5.8% per week. That's a very good rate of return. Remember the power of compounding chart? 5.8% is not even on that chart, but that's what it was mathematically. Now, what about the losses? Do we have any losses? Yes. Well, you can see if we got 50 out of 53, you know that there were 3 losses, but we defined our risk. It wasn't the maximum amount. It was defined by 2 times the potential gain in those trades. Okay, so again, what do we have? Again, if we're looking here, 5%, 13 weeks, we're a quarter of the way, you know, to this number with $10,000. Okay, but again, realistic expectations probably should bring your eye back to here. Now, are you going to be disappointed if it goes from 10 to 46 over a year? You shouldn't. What if it goes from 10 to 25? Would you be happy with that? Sure. Anybody with realistic expectations of trading should be happy with those kinds of returns. I'm just showing you based on a mathematical calculation what it looks like. Okay, I've already shown you the trades that I've taken. I've already shown you how it comes about, how it's generated. And the strategy, again, was running close to 94% success, with the other 6% being controlled risk. Okay? So again, that is the strategy. I will back up because someone's asking, well, did you really show us how it's done? And the parameters for selecting the trades is still pretty consistent. Let me see if I can get it back up here. Okay, bear with me. I'll have to back up manually. But again, the essence of the trade is to identify where prices will likely not be and allow time decay to make you money. Again, high probability trades, again, it's not 80%, it's above 90, 94% so far this year. We're looking at making money overnight. It's not a big exposure. We're using daily and 60-minute charts. I'm not using any fancy indicators, okay? This strategy can be done with regular bar charts or candlestick charts, as long as you can see where support and resistance levels are based on previous highs and lows. Maybe you have a momentum indicator like MACD, okay? And then use your Fibonacci retracement and extension levels that come with most trading platforms, okay? Your goal is to make money overnight income, all right? I will teach you how to do credit spreads, and I will teach you to see the chart from a different point of view. The point of view that you need to know and be able to see the chart patterns and identify areas where prices will most likely not be. That is the most important aspect of this. Where will prices not be? And if you can do that, you can benefit from theta decay and generate roughly from 4 to 8% per week. Again, the number that it actually totaled it out to was about, what, 5.7? Okay, and then learn how to manage your risk. Risk is very important. Now, if you summarize all of this, sorry, I have to do this manually. Okay, when we are looking at this, again, you want to win vast majority of the time. You want to have consistent weekly income. You don't want, okay, to make 1% one week and then 20% the other week. You know that in trading, consistent gains can compound over time. And then most importantly, in my mind, is to control your risk. You don't want to, you know, I know I've heard of iron condors and, oh, it's a 90% success rate, but you trade, you win 9 winners, and then that 10th loser, the last loser, that blows out all your gains. That's not what we're about here. We want to control our risk. Yes, we're going to take losses, but our losses can come back. You can make up one loss in the other winners in that same week. It's very, very possible. Okay? All right. So let me just see here. Couple of quick questions. How do I know when the credit spread reaches the 2 times the credit received? Tim, that's a very good question. Let's say you're willing to, you sell a spread and you get $50. That's the credit you should receive at expiration. Well, the most you're willing to lose is $100, right? That's 2 times this amount, okay? Now, it's really weird how you enter the stop, but basically, this is like 50 cents, all right? So I'm willing to get stopped out at $1.50, right? It's like, that doesn't make any sense, Dave. Trust me, I've actually held the position almost to expiration just to prove to myself this works out. Because what is the difference between $1.50 and 50 cents? What is the difference? Well, you subtract the small number from the big number and you get $1. Okay, $1 times 100 shares, and that's where you get $100 loss. That's how we can control it. Raj, sometimes they do gap and sometimes they move against us. Now, depending on the way it moves, okay, it's not that we're selling these credit spreads right up against the current price. Now, if you're doing it during earnings and it gaps, well, that's your own fault, because I explicitly say you don't do this at earnings because you don't know which way it's going to move. But there are ways to mitigate it. Now, there have been a time that we actually had to take a greater than 2 times max loss. It just happens to how we trade. But lots of times what happens is if you do get a gap, you always have to remember it's a spread. So you actually have 2 options that are gaining in value, okay, or losing in value. They're moving together. It's only when you get right very close to 4 o'clock that the spread actually narrows, and then you reach the potential maximum, okay? But the strategy is also there to manage that. None, John. John, I'm sorry. I'm going to have to answer that particular question a little bit later. Okay? So this is what I'm actually offering it to you guys now. I really wish today was Wednesday, because I would say, hey, take a look at this workshop. Come join me tomorrow, and we're going to input them. Right now, someone asked me, what are my credit spreads in now? Let me just double check here. I have a credit spread, 11-hour credit spread in Priceline. I actually have a bullish put credit spread in Amazon, and I also have, I have to remember because I have them a little bit mixed up. I also have a trade in Baidu, Priceline, Baidu, and Amazon, and all 3 actually have profits right now. Sometimes it's not the case, but normally you see that burst in profits at the first thing tomorrow morning. But here's what I can offer you guys, okay? This is my 11-hour credit spread strategy workshop, okay? It is what I call on demand. It is available right now to you. And I've done this on a Tuesday, I've done it on a Wednesday. They get the workshop and they join me on Thursday. By the time by the end of the day on Friday, they already have profits well above the cost of the workshop. And you'll see what I mean in a second. But again, the benefits of this strategy and this workshop, it's going to show you in detail exactly the steps, almost checklist-like, how to make what I call weekly profits, and they are in the market, by being in the market only 1/3 of the time. If you think about it, the market's open 5 days a week. Now, that's roughly 35 hours a week. Now, we're in the market only 11 hours, roughly. Okay? So when you're not in the market can't take your money away from you. Again, I've shown you it's a high probability trade. It's 94%. Okay? 94% so far, 50 out of 53 trades. And we're just trading 2 days a week. Now, I have traders that are retirees. They like to play golf. I'm thinking of a couple that have basically were in this the first time I offered this workshop. And they use it as a set it and forget it strategy, and it can manage itself, because once you put the trades in at noon on Thursday, you put your stops in there, it can manage itself. Okay? I also have one trader that does primarily futures. He uses this strategy as an income strategy on the side. He doesn't have to monitor it, doesn't have to manage it. He just does it every single week. Now, in this workshop, I detail a step-by-step method, because this is probably the most stressful part, identifying where I call the optimum spread strike prices are. Where will my short strike be? Okay, how do I balance that out with how much credit I can get? Okay, I teach you that in the workshop. Now, I also define and explain the risk control method and exactly how to implement it. By controlling your risk and having a consistent trade that works consistently and brings in a steady income, as long as you can control your risk, that will foster long-term profitability. Okay? Now also realize that this trade, because it's set up on weekly options, that there are weekly options every week of the year that actually expire. This trade can be run 52 weeks a year. No joke, 52 weeks a year. Okay? So right now in the chat box, I'm putting a link that you can click directly, and it goes to valuechartstrading.com/11 for 11-hour options trading. And the special deal that I can give to you, this is what it will look like. This special webinar offer is for $49. The value of this course is $150. Easily. I have traders come back to me the next week after they implement the strategy, said, Dave, I would have paid the $150. But because we're doing this in conjunction with Fausto, and just as a thank you for spending the time with me tonight, I'm going to give it to you for $49. Okay? That right there, my friends, is the cost of a reasonably nice dinner with your spouse. Take the course, make money every week so you can take your spouse out every single week. Okay? It's a nice, consistent way to make money. And it definitely is worth it. It's worth the $150 because it's something. It's like the 11-hour options strategy, and I guess one of my traders from the last time I held it explained it best. He said, Dave, I can depend on the strategy to be easy to set up. The parameters and the checklist that you've given me make it easy. I find the candidates that are good, and then I just go in at Thursday at noon, put the orders in, and when I get filled, I put my stop loss in, and then Friday afternoon, I'll take a peek at it and see what happened. I think this gentleman was still working full-time, and every Thursday he would structure it so his lunch period actually fell right around that 12 noon Eastern time, and he would just implement it. And so, I mean, really, this is a very straightforward, kind of formulaic type of strategy you can run every single week. The course, a couple of quick questions. Do I ever close the spread early if it's not threatened? Actually, I could. And sometimes you want to get out. You don't want to watch it all the way till Friday. Once you have your stops in there and it's going your way, you really just let it expire. The main reason is the credits that you receive aren't as huge as, say, a monthly credit spread, but so you want to maximize your income, and as long as it's not being threatened, you don't want to buy something back for like a nickel when in the course of a couple of hours it'll expire worthless anyway. Okay? Now, the question about this workshop, it's actually on demand. So after you go through and make your purchase, you will get immediate access to a recorded version within the valuecharts.com website. And you can watch it as many times as you want. It will be there for you. I would actually advise you to probably watch it at least twice. Once for knowledge, once for maybe taking notes, and then nailing down the strategies. The list of stocks, I believe they are in the workshop. Now, if you are looking to see that, it's actually very easy. You just go to like Yahoo Finance or something like that, and you find the 100 most active put call stocks out there, and then you basically cross everything off that's less than $100, and those are a reasonable list. Okay, you can file them from biggest to smallest. Everything that's $100 or more, and then what you're going to find is your list is going to be exactly like mine. Those are the ones that you want to do them. But Shirley, hope I answered your question. Everything is on demand, so you do have to have the internet access for that. Yeah, that's no problem at all. I have some of my best spread traders have both watched this workshop several times as well as implemented the strategy. So they're always giving me suggestions on which ones to do. Valen, I like Thursday because of just the overnight transition, but you can take the same parameters and apply it on Wednesday. There is a little bit more risk, but what's happening is you're also going to be getting slightly higher amounts of premium. Okay, as long as you follow the strategy and you're looking at least at a 60-minute chart, be a little bit more selective of this setup or the price action, you should be fine. Absolutely. Dan, yes, this has a checklist. Remember I said one of the most important aspects of it is the step-by-step method for optimizing the spread strike prices. And then, because what happens is you can put this strategy on everything, but you have to go through the checklist and say, okay, this one meets those criteria. How can you set up for the 11-hour strategy? If you want to see me do these trades like I do normally on Thursdays, you actually have to be in the trading room, and that would be at 12 noon on Thursday. I think after you get the special webinar offer, after you get the strategy and the on-demand workshop, then you're actually going to be offered, I think it's a $7 trial for 30 days for access into the trading rooms. So what I tell people is, like, look, $49 is the nice dinner, $7 is the after dinner Starbucks. You take both of those, not only do you get the strategy, but you can watch me trade it for 4 weeks in the trading room. It's a really good deal. John, I don't think we have the capability to generate a CD. I understand what you need. I just don't know if that's something we can be set up to do. Send an email to support@microquant.com. Let's see if there's anything we can do for you. I honestly, I don't know, but if there is, I'm sure we will give it our best effort. Can you use this strategy on monthly options with 2 days until expiration? Tim, on monthly options for those last 2 days, for that last week, that monthly option becomes a weekly option. It's only, a weekly option is just based on how many days it has left. It doesn't matter if it started at 90 days out. No, they are not naked puts and calls. They're spreads. Tim, this can be implemented with index ETFs. The problem that I've found is there's not much meat on the bone on those. You don't have the implied volatility. You don't have the premium on there that will really make it worth your while. And in order for you to do it, you'll have to buy or sell a lot of spreads. I was showing you 10. You probably would have to do close to 100. It's almost like a 10 times factor there. The room after the platinum membership, which includes both of our trading rooms, the futures, and then mine, which is the stocks and options, that is $97 a month going forward. Yep. You're welcome. Any more questions, anybody? Again, the one question that I get, and I'm going to touch base on this just one more time, is the cost. Okay, the value of this course is well over $150 just for what it can bring you on a weekly basis. Okay, and if you couple that with a 30-day trial, I mean, really, both of them put together is giving you both experience in the trade, but also implementation of the trade and managing the trade. It's a type of trade that is not going to go away, because options are here to stay and they always expire every single week. This strategy gives you that checklist of how to take advantage of that particular time decay phenomena that always occurs from Thursday night or Thursday into Friday morning. It will happen today, later on today or tomorrow, and you can benefit from that every single week. Weeks like today, where the markets are moving a little bit, but they're relatively calm, is almost the best time to do this spread strategy. Because when you transition from Thursday to Friday and everything is kind of flat, flat is good, because that means there's not much volatility. And when options buyers and sellers see that, well, options lose their value very quickly because they're out of the money. So right there, just the value proposition of this particular offer is tremendous, because I will be teaching you something you can do every single week consistently to bring in more and more income. You can scale it up as much as you want, okay? You can invest as much as you want in this strategy. I always say be cautious, especially at the beginning, but it is one component of trading that you can implement every single week, and looking for that consistent income. Okay? I do have people that do it in individual retirement accounts. You just have to be careful. Just like you do it in a regular cash account. Hey, John. Really quick question. Guys, I'm going to leave it right here. I want to answer John's question because he's asking me about my my Vanderbilt experience, and specifically about I'm in Pennsylvania, so I understand the current coach for Penn State is the previous football coach for Vanderbilt. I really like James Franklin. I think he was a very motivating coach. I can't deny that he turned around Vanderbilt's program, because Vanderbilt is in the SEC and they have tremendous football in the SEC. And when I was there, we would go to the football games to watch the opposing team, because you got to see Florida live, you got to see Tennessee live. Oh, that hurts just saying it, doesn't it? But Alabama, we play Alabama and get creamed every year. So James Franklin gave us some pride, built our program, gave us a chance to win. So I can't deny that. I felt terrible when he left, but I can't blame him. Penn State's a great program, and I think he's really going to turn it around. So. All right, well, thanks again, guys, for letting me step aside there, talk about Vanderbilt and Vanderbilt football. John, I was one of them. I cried that night when I heard it too. But actually, my favorite player at Vanderbilt that year is Jordan Matthews. I just admire the kid, and it made up for it when he was actually drafted by the Eagles. Yes, so I was healed a lot, and I'm very proud of my school, and because student athletes that have to study like they do, it's absolutely amazing. I had a lot of friends that were athletes, and not just national stage athletes, stuff like now their baseball programs getting recognition. It's great. All right, thanks again, guys. So. Last call for any questions regarding the 11-hour option spread strategy. I'm more than happy to answer any more questions. A lot of the details, fine details, good questions, it's outlined in the strategy, folks. It's in the webinar. How long is the recording? The recording is about an hour and a half to, I think it's an hour and 15. It's not a hyper complex strategy. I don't like complicated stuff, and more complicated stuff that you try to implement in the market, yeah, the more difficult it is going to make money. This is very straightforward. It is very fundamentally sound, and it's relatively easy to implement. It is easy to implement, and over time it becomes easy to evaluate. You'll be able to do it. A couple of weeks doing this strategy, you could do it on your own, okay? And that's what I want to provide for you. Okay, it's a great offer. Again, thank you for Fausto hosting us. Want to give you some good value that you can take and implement next week. I wish I could say implement tomorrow, because past couple of webinars that I offered is exactly the same thing. That, hey, I had people emailing me late Friday, Dave, I got the workshop. It was a great deal. I understood it. I gave it a try on on Thursday, and guess what? I made money, and I made more money than the course cost me. And guess what? I'm going to do it every single week after. That's what makes it worthwhile to me, so that you guys can have a good strategy that you can implement consistently, and that you get to know us here at Value Charts and see what we're about. So, all right. All right, well, I'm going to leave this up. That way, anybody that has any additional questions is right there. Also, in the chat box, there's a direct link to valuechartstrading.com/11, and that way it'll get you right there. If you have any questions at all, questions, concerns, difficulties getting your recording, send us an email to support@microquant.com. We have a dedicated guy that all he does is take care of our clients, and he does a wonderful job. He may even still be in the office, but if for some reason he's not, he'll be with you first thing tomorrow morning. He'll take care of any questions that you might have. And again, if you have any questions for me, you can always forward it to support@microquant.com, and then it'll get to me. We'll take care of you. Oh, sorry about that, Arvid. Here we go. You don't see the link. I'm going to post it again. Thank you for asking. Look in the chat box, and there it is. It's going to say valuechartstrading.com/11. That way it's right there, right for you to click on. Arvid, did you get it? It should be pretty easy to type in if you want a direct type. It's right here. www.valuechartstrading.com/11, the number 11, 11. Sorry for the difficulty. I don't know, sometimes that chat feature doesn't quite. Oh, hold on. I know why. I'm going to do it one more time. I'm going to do it to everybody. There you go. valuechartstrading.com/11. Sorry, everybody. Anybody have last-minute questions? I'm very proud of this strategy. I think you will love it. You will love it. Okay? All right. Well, I'm going to leave this here. Again, if anybody has any questions, feel free to let us know. And okay, clean it up so it's nice and pretty. If you have any questions, feel free to contact us. Again, thank you very much for your time. Thank you for Cyber Trading University for sponsoring us. Let us know how you like the strategy, and let us know how successful you are. We always love to hear, that you're doing well, and because we know this will work well for you. So, all right, everybody have a safe evening, and stay warm there, most of the USA. It's going to be kind of cold tonight. All right. TJ, let me answer that question. Thank you for asking it again. What we do sometimes, if we look at if for some reason the stock is moving and gapping against us, what I sometimes tell my traders in the trading room is remove the stop temporarily, because you are correct. You could get easily triggered if it gapped. But if you notice, a lot of times with gap trades, when the stock gaps, lots of times there's a move to fill the gap. And when that happens, that gives us a chance to reevaluate, because that initial move does something to the option prices that when the gap starts to fill, the dollar amounts kind of shrink. And that shrinkage in the option value actually causes the spread to lose value relatively quickly. And you know, a lot of times Fridays we'll fill the gap, and every once in a while we'll bounce, or we will continue. So I mean, there are options there. But again, you are correct. What I normally tell my traders to do is you can temporarily move the stop, just so that initial bouncing around doesn't necessarily knock you out, because you don't know what that was going to do to the option price yet, because nothing's trading. Yep. You can always put it right back on and stop yourself out manually. But that was a good question. Thank you. All right. All right, everybody. Everybody have a great evening. Thank you again, and have a nice, safe, and enjoyable evening. Look forward to seeing you guys in the trading room. I hope you take us up on that. Always like to have new people in the room. That 94% winning rate, why don't I just use naked options? It's more so because we do a lot of directional trading in our trading room also. People like this particular strategy because it's kind of compact. It's easy to understand. That's why we would kind of standardize the way we go about it every week. Thank you, Raj. Raj also mentioned that with naked options, the buying power requirements are much bigger, and people don't like that. If you're actively doing it, you could apply this strategy with those, but again, it depends on what your comfort level is. I like to have it nice and compact, that you know, one guy can do 10 contracts, one guy can do 2. They don't feel like they're, you know, they have to, because a lot of times people don't have as much capital as some. This is easily, each $5 wide spread is only $500. So depending on how much you have in your account, you know, you can implement a certain amount of your account to the strategy. Yeah, I understand, Chris. Like I said, if you want to apply to those naked options, no problem with that. I completely understand. The leverage is definitely there. So, Sarita, thank you. Okay. All right, guys. Thank you very much. And again, if you have any additional questions, feel free to send them through support@microquant.com, right there on the bottom of the page. And we'll take care of you. Okay? All right. Good luck trading. Thank you again for tonight. Bye-bye.